Amidst all of the chaos last week, the world's largest asset manager, BlackRock, quietly announced something that should be making a lot of people extremely worried. They would be limiting withdrawals on one of their flagship credit funds that currently has, or at least had, $26 billion worth of assets under management. Now, I know that there is a lot going on in the world right now, and compared to some of the headlines we have seen in the past week, this might sound pretty minor. But a hiccup like this in these markets could genuinely be the sign, symptom, and cause of something much scarier. On one hand, people pulling money out of these kinds of funds is a sign that things are not going well amongst even the most high-end investors. On the other hand, the fact that they can't get their money out is a symptom of people predicting things are about to get much worse. And on the third hand, a shocking amount of everyday businesses have been propped up by the easy lending done by these firms. If their money stops flowing, it could easily cause much larger knock-on effects throughout the real economy in extremely direct ways. But before we get too hyperbolic, it's important to understand exactly what these funds were supposed to do, and more importantly, what they have actually been doing. Because depending on your interpretation of this business model, this headline is either little more than dumb investors not understanding what they invested in, or it's the modern equivalent of a bank run. The total debt outstanding in this highly risky class of finance is now over $2 trillion, almost twice as much as the $1.3 trillion in subprime mortgage lending done in 2008. And with an alarming number of parallels, it's clear to see why some people are getting nervous. Now, that alone is not great. But it gets worse. If one BlackRock fund really was the only fund having problems, it could probably just be written off as a concerning but ultimately isolated incident. Unfortunately though, this week's announcement was just the latest and so far largest example of major issues in these multi-trillion-dollar private markets.
I want to start with BlackRock.
BlackRock said that about 54% of investors' redemption requests were granted. That means
for a loan to go from 100 to 0, something really dramatic has had to happen to the company.
Walgreens is laying off workers.
About 500 locations will close before the end of the current fiscal year.
Blue Owl Capital closed almost 8% lower.
Blue Owl has become kind of the whipping boy for private credit.
Private equity, private credit is a mess.
Firms are saying this will be the year. We'll see if that's the case.
Okay, so just like private equity, the definition of private credit is actually pretty broad. Private credit is just any lending done by non-bank institutions in privately negotiated terms rather than being done through corporate bond sales. If you were to loan money to a friend so that they can start their business, that is technically private credit. But today, the scope and scale of these private deals for huge amounts of debt has grown for three distinct reasons. In the bad old days, if a business needed to raise cash but it didn't want to sell shares, it would either go to its bank to take out a loan from them, or if the company was really large, it could issue bonds with set terms just like the federal government does for its debt. The system worked well enough for a while. But then several things changed that allowed private credit to slip in between the cracks and eventually become one of the most important lending facilities in the global economy. The first was that, starting in 1982, like most good things, the number of individual banks in America peaked, and it has been consistently downhill since then. Today, there are less than a third as many commercial banks as there were 40 years ago. And that happened at the same time the overall financial industry got much larger in both absolute terms and as a share of the overall economy. All of this to say what you probably already knew. Banks responded to the lack of anti-competitive enforcement and too big to fail bailouts by getting too big to fail. Today, the average bank is not really interested in providing loans to individual companies outside of very rigid conditions, because their scale means that they can make more money with broad market products. An easy way to think of this is that a local burger shop might make a special order burger just for you and your friends if you patronize them enough. But no matter how many times you do go to McDonald's, they aren't going to alter their menu for you. Extremely large banks just make more money by offering standardized products that they can scale endlessly, like mortgages, credit cards, and non-bespoke lending. Additionally, to play devil's advocate a bit, heightened regulation in the wake of the GFC has also made it much harder for traditional banks to give out loans to companies unless they already had a lot of assets in place as security. In almost every economics textbook ever, we are normally told that the role of banks is to secure depositors' money and use some of that liquidity to lend to new businesses so that they have the opportunity to go on and produce more value. The reality is that this barely happens at all anymore, and most bank lending has been directed towards mortgages, personal loans, student loans, car loans, and lending to very large established companies. So this opened a hole in the market that was exploited by far more flexible private lenders who could make a loan for pretty much anything. The second major factor driving the unprecedented growth of the private credit market has been the equally unprecedented growth of the private equity market. Now, we have spoken a lot about the extremely complicated debt structuring done by private equity firms on this channel before, and I respect your time, so I will keep this brief. And if you do want a refresher, I'll leave a link to our old How Private Equity Works video in the description. But the basic rundown is that a fund will raise money from investors and use that as effectively a down payment to borrow more money to buy a portfolio of private companies, which will each get to take out their own loans to pay back the original fund, which will use that money as a further down payment for more debt to go and buy more companies that will take on more debt. This isn't even mentioning the secondaries funds or the managers of limited investors who themselves often use their stake in a fund as security for further personal lending. The whole system relies on debt, piled on debt, piled on debt to maximize leverage for higher potential returns, and also to manage liquidity. Private companies are notoriously hard to sell if an investor wants to cash out of the fund, so using debt instead of a sale lets them facilitate those transactions within reason. Now, hopefully it should go without saying that this whole thing is incredibly risky, and the only institutions that have really been willing to operate in the space have been private credit funds. And well, you have probably guessed by now that they raise money and take on debt in much the same way as these private equity buyout funds do. As investors in these funds saw that they could make 20% returns every year on paper, more money piled in, which helped to make those earlier investments look even better. This system of debt on debt on debt on debt on debt on debt in a growing market has generated some fantastic paper returns, and made private credit just as, if not more, attractive than private equity itself. And that's why the third thing that has allowed private credit to grow so quickly is that unlike the private equity funds, they don't need to go out and find individual businesses to invest in. They can operate at a much larger scale by just building relationships with a pool of existing funds and other companies that want to borrow money. Recently, this lending has also extended to businesses that want to build out data centers, potentially exposing them to an additional market bubble if there is a correction there. So these three factors allowed private lenders to fill the gap in the market and make huge returns while growing at an unprecedented rate year on year. But at a certain point, they ran out of good loans to write, and now that interest rates are giving the system the slightest hint of a reality check, there are already rumors swirling about the Fed being forced to bail out an industry that has again become too big to fail without anybody noticing. So it's time to learn how many works to find out what happens if we don't bail them out. This video is sponsored by Svibe. If you've ever traveled internationally and been hit with a roaming bill that looks like a car payment, you already know the problem Svibe solves. Svibe is an eSIM app that lets you buy affordable data plans for over 200 destinations worldwide. No physical SIM card required. You just download the app, pick your destination, and you're connected the moment you land. Plans start as low as a couple of dollars, which is genuinely a fraction of what most carriers charge for international roaming. And it comes with built-in web protection and ad blocking, which actually saves you even more data while you're abroad. I've been using it, and the setup takes less time than it takes to get through airport security. You just install the eSIM profile through the app and activate it when you arrive. No swapping cards, no hunting for local SIM shops, no drama. Whether it's a business trip or a vacation, Svibe is a no-brainer for anyone who travels and doesn't want to get price gouged on data. Download the Svibe app or go to svibe.com/howmanyworks and use code HowManyWorks for an exclusive 15% discount on your data plan. You can also scan the QR code on screen right now to get started. Okay, so the one thing that is important to note as we start to explore how these good times came undone is that the institutions putting these loans together are fully aware that the lending they are doing is highly risky. Because private lending is, well, private, market data is very hard to aggregate. But according to information from PitchBook, the average run-of-the-mill private credit loan for a small business with more than $50 million in EBITDA was between S plus 500 and S plus 550. Now, if you don't speak finance, bro, that just means the risk-free rate plus 500 or 550 basis points or 5 to 5.5%. At the moment, the secured overnight financing rate, or SOFR, is around 3.7%, which means that the most basic loans are given out at an interest rate of 8.7 to 9.2%. Now, there is a reason why they are quoted in such a confusing way. But for now, the point is that this is a high interest rate that suggests a significant amount of risk. And this is also for a business maintaining 60% equity as a security, which is kind of like if you were putting a 60% down payment on a home loan. Clearly, it only gets riskier from here. In their prospectus, BlackRock's private credit arm acknowledged this risk, but also pointed out that by lending to a large pool of businesses, the individual credit risk would be mitigated and strong overall returns could be maintained even in an uncertain market. Now, that might sound concerningly familiar, but with so much new capital rushing into the market, private credit providers were happy to write loans wherever they could find them. So then, what went wrong? Well, when this first started, private credit was genuinely a good idea. The early funds filled a gap in the market for easy business credit that was underserved, and they were able to write good loans to good companies with good terms. But as investors piled into these funds, the pool of capital they had to work with grew faster than the pool of good borrowers they had to serve. Private equity funds helped to fill that gap because their buyout model relied on lots of borrowing to generate strong returns, or at the very least, pretend they were generating strong returns. But these loans came with their own separate risks. A lot of underlying problems in the private equity market were paved over by new investors piling in. This allowed funds to sell their portfolio companies to generate cash flow and cover their debt, until the point where eventually the biggest buyer of the businesses sold by private equity firms became other private equity firms. This is kind of like if property flippers just flipped properties back and forth to one another. So long as new property flippers kept entering the market, everybody could pay off their mortgages. But private equity has not been having a great time recently. New fundraising is down, and a lot of investors are trying to take their money out only to realize that it's going to be a lot harder than putting it in. This rush for liquidity in these illiquid markets has created problems up and down the debt supply line. According to Fitch, defaults in private credit reached their highest levels ever since January, and we are still waiting on data from February. Now, one little point to note is that this market is so new and opaque that Fitch has only been tracking this data since mid-2024, so there is not that much historic context to go off of, but it still isn't trending in the right direction. The second problem is simply just rising interest rates. Now, you might think that for a business that generates returns by charging interest, that higher rates would be a good thing, but it's actually the opposite. If investors can get a 5% return just by sticking their money in a risk-free treasury, that makes the highly risky 9% returns offered by the private credit industry a little less enticing than when the margins were much wider. Additionally, there is only so much interest these funds can charge businesses before they start killing them. Remember, the interest rate is a base rate plus a risk premium on top, which means that if the Fed changes interest rates, that gets automatically passed along to these businesses. What's more is that as interest rates have increased, they themselves have become a credit risk to the business. The difference between paying $4 million in interest on a loan and $8 million in interest on the same loan could be enough to put a lot of firms out of business. This is especially true for private equity structures that have had several layers of debt built into the system. Ironically, these credit lenders have had to account for the increased risk of high interest rates by further raising interest rates. Private credit funds are also hurt by interest rates on the other end as well. Some funds take their investors' money and borrow more money on top of that to take advantage of the split between the low interest rates they can borrow money on and the higher interest rates they can charge the businesses they are lending money to. As the rates that they can borrow money at has also increased, it has led to tighter lending standards and higher interest rates. It's also worth mentioning that while this is minimal compared to the overall size of the private credit market, this borrowing has mostly been done from regular banks, so they are not completely isolated from this industry. Again, the data on this is incredibly hard to come by because most of these deals are not public record. But according to a release from the Fed, they noted lending commitments of $95 billion to private credit in Q4 of 2024, a 12x increase over the decade before. That is the most recent figure we have from the Fed themselves, and this alone won't individually take out the banks. Although even at this level, the Fed did highlight it as potentially systemic risk to the banking system. So, not great. But within the last year alone, that exposure has more than tripled. Further analysis from the ratings agency Moody's found that today, bank exposure could be as high as $300 billion. And even in a perfect economy, that is major exposure to a highly risky asset class. And well, yeah, the economy is also far from perfect. The final big blow to private credit has been the turmoil experienced by the primarily mid-sized companies they lend money to. Jobs numbers have seen consistent downwards revisions for more than a year now, and just last week, it was noted that we had lost 92,000 jobs in the month before. This indicates two things. The first is that businesses are looking to cut costs where they can. Market turmoil, increased interest rates, and tariffs have been a major upset to regular business operations. And if those businesses already have a lot of debt, they have less capacity to absorb these shocks without cutting expenses like staff. But not only are these job losses a sign of trouble in the wider economy, they could also be a cause of trouble within private credit specifically. Rising unemployment means fewer customers for exactly the types of businesses that are typically laden with this kind of private debt. And if they don't have customers, they don't have income, which means a further feedback loop of layoffs and defaults. So that's the current state of the private credit industry. But if this really does come crashing down, are we potentially looking at another global financial crisis here? Again, we don't fully know exactly how much private credit debt is floating around in the system, because, well, I know you are sick of hearing me say it by now, but it's private. Morgan Stanley suggests that the total private credit market was around $3 trillion at the start of 2025, which would make it more than double the $1.3 trillion worth of subprime lending that was done in 2007. Our economy is much larger overall today, and our banking system is better capitalized. But if these financial products saw the same kind of correction, it could have a similar strain. These loans are also not just financing houses. They are financing businesses, which means services, inventory, and payroll, all things that could impact productivity more widely than just a simple home foreclosure. Not that either outcome is pleasant. It's also worth realizing that even if we do go the bailout route for these, again I have to reiterate, private lenders, the government is not as healthy as it was in 2008. Our debt is higher, inflation is already a problem, and unlike the early 2000s, this debt didn't even let regular Americans pretend they were rich for a little while. Now, I just want to say that for the record, I really genuinely hope I am wrong about this. But these concerns are shared amongst basically all of the big names in finance at the moment, and the only real reason why people aren't making a bigger deal about it is because of everything else going on in the world at the moment. But if you want to see the other side of this whole system, go and watch this video next to find out the impact this debt is already having on regular businesses as we capped off a record year for corporate bankruptcies. And don't forget to like and subscribe to keep on learning how money works.